Hey folks, Dan Frio here with your closing bell for September 22nd, 2025. So mortgage rates, they didn't move at all today. And the reason why is there was just no economic news that would really make these things move. If you go over to the stock market, a little bit of different tune there. You go across the board. Well, we start out with Bitcoin. Bitcoin's not having a good day, but most people don't own Bitcoin. So if you go over to the overall markets, pretty good day across the board through there. We got the VIX up just a little bit, nothing to really write home about. And you got oil down as well. So kind of a Cinderella story unless you got Bitcoin. But I do want to answer the question. The number one question I'm getting from basically last Thursday to today is, Dan, why have mortgage rates went up even though the Federal Reserve cut rates? Because I sat on the sideline once again, just hoping that the Federal Reserve would cut rates and not this time that where mortgage rates would go back up. Well, that's what's happening again. So why are mortgage rates going up? So if you're watching this video and that's your question, my goal today is to explain to you guys what's going on with those and the whys behind it. So let's get over to it, folks. So here's the news we got today. It was basically nothing. Okay, but what I want to show you guys here, there's nothing on a Monday. But the reason why mortgage rates went up and the Federal Reserve cut rates is because the Federal Reserve doesn't control mortgage rates. Basically, what it controls is what's called the federal funds rate. So let's get over to it. Here's the federal funds rate. Right now, it's 4% to 4.25%. There's a 0.25% spread in these. So you're going to see that pattern throughout, and it's always been that way. So with the Federal Reserve, they were created for two reasons, or two mandates, was to keep prices in check, aka inflation, and to keep jobs at full employment. And full employment is anything under 5%. Okay, so that's what they monitor. And they also monitor the GDP, how robust our economy is doing. Is it growing or is it shrinking? So this is the stuff that they monitor. So you might think, okay, based on this information, why would they cut rates? Because everything looks pretty good. We do have inflation a little bit hotter than expected, but they came out and said their main goal this time is the weakness in the jobs market. Because over the last month and a half, we had a report that came out and there was 990,000 jobs lost. And then a couple weeks ago, we had another revision of another, I think it was 200 or 220,000 more people. And then last week, we started getting contrarian information saying, okay, the jobs market doesn't look all that bad. So there's a lot of, moving parts there. And then on the inflation side, it's been pretty darn sticky. They were thinking, with the tariffs taking effect, the inflation, especially the PCE, would spike up to 3 or 4. And it hasn't. So now, based on the data that the Federal Reserve gave us last week, they're saying, okay, we're not that concerned about the inflation right now. We're going to monitor it because more and more inflation is coming in from tariffs. But our main concern right now is the jobs. Okay, so they cut rates. So what that tells us is basically the Federal Reserve cut rates because they don't want the jobs market to sink anymore. They actually came out and said they did it as insurance to basically avoid a catastrophic jobs market. Okay, but when you're focusing in on mortgage rates, it's a whole different avenue because it's controlled by bonds. And here's a bond. Here's what's happening today in the bond market. And this one is a mortgage bond. So if you're new to my channel, I want to explain to you what we follow on this channel to figure out what's going on with mortgage rates. We follow a mortgage bond, and it is right up through here. You can see it. It says MBS 5.5. Okay, so what you have to understand about this chart, and basically two things. If the chart goes up, which it isn't today, but we like when it goes up, when the chart goes up, that means the price of this bond is going up, thus the yield is coming down. There's an inverse relationship there. Okay, so today we saw the MBS went down 17 ticks. That would normally, in a normal market, push up rates. Okay, prices go down. It's kind of the reverse. Prices go down, rates go up. So if you go over to the market through here, it's saying this didn't move. So it did have a later revision down through here. So I think they shut this down pretty much midway through the day. So you might see a revision tomorrow. This might be revised by the end of the day. So you do have MBSs down 17 basis points. So what really affects mortgage rates? Well, the long end of the bond market. So if you're investing in long bonds, here's what really affects it. Inflation, the jobs market, a lot of the things that the Federal Reserve monitors. But the one piece of the puzzle that they really don't pay that much attention to is the deficit. And yes, they do, but the long end of the bond pays the most attention to the deficit and a lot of fiscal policies affecting that. So the biggest thing right now that we're facing is tariffs. When are they going to be put in place? How high are they going to be put in place? Are they going to be legal? And none of those things have been brought to the forefront yet. So what we have now is more of a risk premium in rates. So now you understand, even though more short-term rates might go down, a lot of the fiscal policies that we have that control the back end of the bond market is still uncertain. And again, the tariffs, we don't know where they're going to go. Are they going to be legal? What are they going to come out to be? So now you're seeing the bond markets not doing well on the long end of the bonds. On the short end, it's doing pretty good based on what the Federal Reserve did. So the Federal Reserve controls kind of what short end things are doing, like car loans, credit card loans, personal loans, where long end maturities like 10-year, 20-year, 30-year bonds are affected by more of fiscal policy and things behind the scenes that there's just uncertainty about right now. So I know it might be a little confusing. Dive in a little bit more to the bond market to help understand that. But I do want to go over to show you guys, here's what the Federal Reserve, this is the rate they control. Here's the numbers that they look at. But they were out last week. The Federal Reserve met. And this is basically what they call the dot plot. And I know I did this last week, but a lot of people might have missed this. So the Federal Reserve, when they come out 4 times a year, they meet every 6 weeks, but 4 times a year they come out and they put a dot, each one of the voting members puts a dot where they expect the federal funds rate to be, the rate that they control. Okay, so if I get my head out of the way, I'm going to show you kind of what's going on behind the scenes. So here was another, discrepancies that happened. I'll try to scroll it in a little bit further if I can for you. I don't want to lose the screen, so my apologies if we lose it. I'm going to have to go back through and find it, and that's why I don't like doing this. So bear with me real quick. I'll try to cut this out and edit. But here's what the Federal Reserve basically put as their dot plot. So here's the year down through here, so you can understand it's 2025 and then 2026 next year. And here's where the rates are. So right through here is where we are right now. That is between the cells of 4 and 4.25. Okay, but the majority of the members are down through here, showing the federal funds rate would be 3.5 to 3.75, meaning there's still 2 rate cuts coming based on the majority of the Federal Reserve members. So you have all these members plus this one. Okay, so you add that to that, and most likely, unless there's uncertainty that comes out in the next few weeks on reports, they're going to probably cut rates at the October meeting. Another verification of that is, let's just go over the CME FedWatch tool. What this does is, based on the futures markets, this is telling us what most likely is going to happen with the Federal Reserve at the next meetings. So this gives us this data, the dates of the meetings, and then this across here gives us the federal funds rate. So right now, the federal funds rate is right here. Okay, so this is telling us there's a 89.8% chance the Federal Reserve is going to cut rates 0.25%. Then at the next meeting in December, there's another almost 75% chance they're going to cut again. So again, folks, just because the Federal Reserve is cutting rates is telling us inflation might be better than expected and employment might be better than expected. But the long end of the bond has much, much more intact to it, especially our national deficit. And then we might even have a shutdown next week, folks. So that is also another catalyst that might add another piece of risk premium into these rates. So those are food for thoughts when you're looking at that. Let's get over to the economic calendar so I can show you. Basically, there was no economic news today. So Monday, nothing really out there. I'm going to show you some NVIDIA news that just popped off the wires. But on Tuesday, we're going to get some inflationary numbers. And I thought I would be able to have time to do a report on this to see where these numbers are expected to go, but I'm not. So we're going to go over to here. Based on these numbers on the manufacturing PMI and servicing PMI, this gives us basically how the inflation numbers are going. It's giving us some good news here. It's going from 54 to 53 and 53 to 51. So we're focusing on that. It shouldn't really sway the markets because the latter part of the week, down through here, Thursday and Friday, we're going to get durable goods orders, GDP, initial jobless claims, and then the next day we're going to get PCE. Does look familiar? You go over to here. What does the Federal Reserve monitor? They monitor the PCE, the unemployment rate, and the GDP. So we have a ton of data coming in Thursday and Friday. Unfortunately, I got to go back to visit my mother on Thursday. She is in a nursing home, folks, and I'll be visiting her, and I'll be trying to do my best to maybe post up for you guys to see what's going on in the markets those days. But I will have to go back to visit my mom to do some things back through there. So let's get to what NVIDIA is going. Now, the markets are doing pretty darn good. What did NVIDIA do today? Well, I guess AI is real. They just invested $100 $100 billion in open AI data center. So we're going to talk Stock Talk Tuesday tomorrow. If you didn't invest in NVIDIA, and I didn't either, what are other plays when it comes to all this AI? Because AI is the real, and it isn't the next best thing. So we're going to see what's powering, give you a little clip there, what's powering the markets higher, and we're going to talk about that tomorrow in Stock Talk Tuesday. But if you're trying to figure out, Dan, who are you and what do you do? So, folks, I'm actually a federally licensed mortgage loan officer. I work at a bank that holds a federal license, so I work in all 50 states as well as Puerto Rico. The unique thing is we have a slogan, and it's one application, one credit pool, and we're going to compare your loan to over 30 different lenders. Now, why and how do we do that? Well, why we do that is when you call in, what's the first thing you're going to ask? What's your rate and what's your fees? So we want to be as competitive as anybody else that you call. So we've set up with over 30 different lenders that we can use their products, their rates, and things like this. Wonder if you're looking to buy a house and you need some down payment assistance. We have a program, we have a lender that will give you up to $7,000 in down payment assistance. The good thing about this is you don't have to pay it back. We have that. We have other products that you might not even have access to. So reach out to us. Let us help you. You're going to navigate with me and Alan through this whole process. So even if we work with another lender because maybe they have that product or maybe they even have lower rates, you're going to work with me and my staff throughout this entire process. So how do you do it? Well, just find out a little bit more. Just go to therateupdate.com. If you want to reach out to us, phone number's right over there. And if you want to reach out and look into refinancing, you're out there and you're like, many people are out there, 7.5%, 8% rates. And they're like, I just don't know how to refinance or when to refinance. Well, do me a favor. Go to my refinance button at therateupdate.com, plug in your mortgage information, and all I'm going to do is ask you to do this. Look at your mortgage statement and then put in a rate that's 1% or 1.5% lower than you have now. So what I'm going to do is when the rate hits, I'll be reaching out to you. And it will be me personally. I don't sell your data. I don't want to get into that. But we're going to look at it. I'm going to go over what your new payment would be, what your savings would be, what your costs would be, and what your break-even point would be. And if it's something you want to do, we'll get you locked in the paperwork started. If not, we'll put you right back in the list. But that is it for today, folks. I will be back tomorrow to figure out and explain to you guys what's going on with those and the whys behind it. Thanks for watching. God bless. Have a safe evening, and see you tomorrow morning, folks. Bye-bye.